Happy New Year to you, Rick, and to the millions of our people that are watching us around the world.
Millions and millions of viewers here on 2025, and I'm going to go back and we're going to look at some numbers that really don't mean anything because it was the holiday week, but it's still fun to look at. Some of the numbers are shocking.
Meaningless numbers. I love to look at those. That's what I like to look at.
Yeah, that's right. Take a look at this number. It means absolutely nothing. I mean, you look at the ticker down below, and I'm going to show you our active listings in a chart anyway. But you know how we are averaging about 2,400 new listings coming on every week and about 2,200 new contracts.
Yep.
Well, you take a look down here below, and it's scrolling up there now, and it's going to show you that current active listings are now in the 19,000 range. That's to be expected. New listings, 2,500. New contracts, 1,600. So nobody was buying. So that's, but who does buy between Christmas and New Year's? And we're seeing that. And so we did see, I'm going to go over where our listings are. I'm going to take a look at our months of supply. We're going to talk a little bit about the contract ratio, and I want to kind of prognosticate a little bit with you on, again, saying what I think the first quarter's going to be like. But I also want to put out there that you're seeing a lot of YouTube videos that are just like, this is bad, this is not good, and everything. And I've been thinking about it, and I thought, well, just because house prices are not going up doesn't mean that's bad.
Yeah.
I mean, you know, the old misnomer that real estate agents only make money when real estate's going up is false. And it's what is bad is volume. And that's what's hurting the industry the most. Now, if home prices start going down, they can still go down while volume picks up. All depends on how many listings we got, but it's not all doom and gloom. And, you know, it's what we're experiencing. And there, you know, different schools of thoughts out there is that, you know, the market doesn't adjust quickly. So, you know, maybe we're adjusting to where we start reaching some affordability at some point, and the market balances itself out because it's been so out of whack for the past few years that that's what we're feeling. But it doesn't mean that it's a bad thing. And so, you know, you look at our number of active listings here, and you can see where they went down seasonally. But I had predicted that I thought they would land right about here. I tried to put my red line there. It won't let me do it, but and I don't know what I just did there. I messed something up. So I'll refresh that and see what happens. So the new listings came down seasonally, but I thought they'd come down a little steeper clip.
Yeah.
So having said that, if I look at the number of new contracts that we have weekly now, and we get back to adding the number of listings that we were on a weekly basis, that's going to increase in January. And that's going to put us up above this 24,000 line here, closer to 26 by the middle of February, in my opinion. And that's not an alarming number. 27,000 is considered normal for our market. But again, what's normal, right? And here is the contract ratio at a historic low here. I mean, way down at 29.3 and way back in the doldrums here. We didn't even get that low back in 2022. This one doesn't go back as far as, well, actually it does. Let me pull back. No, they only go back as far as 2015. So, but the contract ratio is, you know, basically a contract success rate. And so it's low. So, you know, are we at the floor? Are we at the very bottom of our market right now? And it sure feels like that. This one is our months of supply, and it has spiked again seasonally, but we're at 4.2 months. The normal word's used once again, saying normal being 4 to 6 months. And then we have list price per square foot. And you can see that we went down in April, and we've been coming down. And then we went back up as we got towards December. And then the last week, they went down a little bit. So nothing alarming going on an average list price, but that takes 3 to 6 months for that to shake out if we're starting to see any movement. Yep. Then the last one here is our good old Cromford market graph here, the index, and you can see that it's been going down, 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 and it went up just a little bit for the month of December. And that's simply because so many listings were pulled off. The other number that I ran into that really, the end of the month, we always have a spike of expired listings, right?
Yep.
And because people, they just write contracts, say, well, let's let this expire at the end of April. And so I was really curious to see what that number was going to look like at the end of the year, which was yesterday. And we've been averaging about between 650 and 750 homes expired at the end of every month. But today, the 7-day moving average, it's 2,250. That's a lot of expired listings.
Mm-hmm.
Goes to show you how many listings were out there that said, well, I'm going to keep it on the market until December 31st. Canceled listings didn't spike, which kind of surprised me, but people just let them expire. No one here says that next step, if employment collapse, then prices. Yeah, everybody's going to be watching every number to see what happens. Here's an interesting thing, and then I'm going to jump to you, Pat, on some rate news. But this is an article that I found in Calculated Risk newsletter, and it's saying single and multifamily serious delinquencies increased in November. So there's your headline. Things are getting worse. The delinquencies have gone up. And then you get down to the devil in the details. You know how I like to see that.
Yep.
They reported that the delinquency rate in November was 0.56, up from 0.55. Ooh, what a jump. It's year over year from 0.54 in November of last year. And then it says, however, this is below the pre-pandemic levels of 0.60. But what's the headline say? Fannie and Freddie, single family and multifamily serious delinquency rates increase by a tick.
Yeah.
And they're still below where they were in pre-pandemic levels. Those kind of headlines drive me crazy, but people grab it and go, here we go. Here we go.
But it is true, though. They did tick up.
0.1 or 0.01.
0.01.
What's that? 3 homes?
Yeah. Yeah.
Now rates, they haven't been moving much because it's the holiday week as well. I mean, you're not seeing too much going on there, right?
Yeah, no, we're not. We're the last, probably last 2 weeks or so. I mean, it's pretty much, I'd say from about the middle of December, people start checking out. I mean, there really wasn't much happening on rates. I mean, we saw a few, I think this day where we saw a little, you see some of these spikes, these little candle marks are kind of the spiky days, like here, this is back in August. But overall, it's been pretty quiet. I mean, the market rates have started up pretty much. It's been this one headline was on MBS Live. It said uneventful start to 2025, but we kind of like it that way, don't we? I mean, I don't see. It said mortgage rates haven't moved much since Fed week. They've been pretty much stuck in this range. I mean, we've got right now, you got the 10-year coupon at 4.56. Once again, we're kind of bad, this right in here, from August of last year, we're kind of in this channel right here. And it's like you and I talked about, I mean, obviously, I think you're starting to see more talk about, obviously, the debt ceiling, the 36, 37 trillion. And we had talked about that, but we'll talk about that a little bit in a bit. But right now, rates, looking at pulling up this $475,000 purchase. This is an example that I typically use, 5% down, 780 FICO score. You're looking at right now, let me just blow this up a little bit for Provident. They're an A-paper lender. Right now you're looking at 7% with is kind of the par rate. If you want to get in the sixes, you're looking at, $2,200 at 6.875. Several months ago, we were looking at, back actually, when was it? September? You were looking at low sixes, but we're looking at a 3-point discount now from that rate. So that's pretty sizable rate where rates would have to come down to get into the low 6% range. it just seems. I was listening to these pundits. The last week or so, some of these housing experts, and it's kind of funny how you and I talk about trying to come to some conclusion or help people give some insight. Just funny how these guys in CNBC, Fox Business News, you listen to them. Once again, you've heard me say some, over and over again, they don't know any more than you and I, because this one lady, this Ivy Zellman, she was saying, she expects more challenges in 2025. It's a challenging market. I like this one, lumpy dumpy in 2025.
Well, Ivy Zellman's the one that's screaming from the rooftop about the Fannie Mae delinquencies.
Was that her in the article?
Yeah. She's the one you'll see her a lot on YouTube, and she's talking, and look, she's got access to more data than I get, but I just showed one right there that said we went up 0.1, 5.6 versus 0.55. Yep. I don't know what she's seeing that's so alarming, but that's, that's her shtick.
She didn't give a lot of, I listened to her interview, and it wasn't like a lot of, because a lot of people try to, they listen to information to try to get information so they can make a good decision. But, if the builders, she was saying the builders are using margin to buy down the rate. I mean, obviously their margins are getting squeezed. Yeah. I mean, if builders are struggling at 7%, what if rates went to 7.5%, 8.5%? I mean, that certainly would be a conundrum that we don't want to, it's hard to say, but I think they're going to sit. I don't see much more. Like we had talked about last year, beginning of last year, what was our prediction? It was going to be a whole hum market. It was a whole hum market. I really, I see absolutely no trend either way right now.
Yeah, I don't either. Well, yeah, I mean, I don't see anything. I don't see any incentive now for buyers to go, okay, I'm back in. I don't see it. In fact, how everybody was waiting before the election?
Yeah.
I think that's going to continue in January, because now they're going to go, well, we got a new president. Now I'm going to wait and see what happens. I think the waiting is going to intensify.
Yeah. I think it will. I mean, it probably will, because I think he's got some things in the works that maybe, I think he will. My take on it is, if he does obviously open up the oil and gas spigots even a little bit more, I think if he does knock out a lot of these regulations, I think they'll have a deflationary effect on. But
that's going to take time.
Oh yeah, no, I'm just saying it's not something that's going to happen in February, March, or April. I mean, it's just not gonna. I mean, it's just a gradual effect. It'll take us. Let's take us to that one. Speaking of that gradual effect, I want to show you that one chart that we talked about before.
And Sid, hang in there. We're going to get to your question here in a minute.
Okay. But this lock-in effect. I saw this chart. This is a kind of a guy that has this nice little service called Weekly Roadmap for Loan Officers. We had talked about it several years ago. I believe I was, back when rates were hitting 3%. Remember, I feel like I read that. I talked about the rate lock-in effect before. All these analysts were talking about it now, but now there obviously that's been a big part of this market. He brought up this chart, which I thought was kind of interesting. It's just going to show that it's going to be a kind of a slow grind, loosening up this inventory, because people say, "Well, I'm not going to sell my house because it's 3% or 4%." Thought this was an interesting, interesting chart. December of 21. We had 3%, 45% of the mortgages were sub 3% right here. This is right here, this blue line. But it's interesting how this slowly has decreased. As of now, sub 3% makes up 33%. And it goes along the whole subset of these rate, tranches, 3%, 3 to 4%. 3 to 4% was 39% of the market. Now it makes 30% of the market. You see 4 to 5% made up 13%. Now it's 12. It's 12% now, it says. So now there's 16% of the market right here that makes up 6 to 8% of the mortgage rate market. So bottom line is, he said 25% of all outstanding mortgages now have a rate of 5% or higher. 27% of sub-3 mortgages went away. So he goes on to say in this little bit, pour just a little bit of rate relief on these stats in a slightly warm housing market, and you can see why some of the economic prognosticators are feeling bullish about the housing in back half of 25. So, it's good. Bottom line is going to take some time to sort through these 3 and 4% mortgages to loosen up. Through divorce, people have to move, job change. That's how you're going to see that. Some people just getting rid of them, selling it. So
it's a slow moving chart too. You just showed
slow grind.
10%, but very slowly.
Yeah.
It's interesting that he says that it'll probably have an impact at the back half of 25. I'm hearing that a lot. Sid has a question here, Pat. Can you look at what investor loans are currently? Would like to understand how they're cash flowing their rentals, or are they losing money? In other words, if somebody's buying or getting an investor loan.
Yeah, I mean they use what they typically will use is called a DSCR, debt service coverage ratio loan. So they'll look at. I mean, I can go into it further if he wants to call me, but investor loans, in some cases, I'd say. I mean, I don't really delve into that market too much, but I have here and there. Mostly, primary, first time, second home purchases, things of that nature. But a lot of these DSCR loans they're usually typically if what he's asking is what are they currently at, they're usually in just a ballpark, usually about half a point higher, than the conventional. I mean, I'm surprised when we have some of these guys that pop on our Zoom call for the company, Price Mortgage, they quote their rates. They're you're probably looking at, I'm just ballpark at 7.5. A lot of these, but they basically cash flow it. It's like they'll take the rents, like say if you're getting rents just to make it, you're getting 2,500. They'll go off the rents, and if you're getting more or getting less, that's kind of where they kind of stay. If you're getting $3,000, that's over a 1.0 ratio. That's positive. I mean, if you're getting negative, I don't know how many are actually losing money. Rentals, it's obviously a property to property case, but bottom line is they're fairly competitive rate wise. They're not like this 2 or 3. A lot of people probably think that their rates are 2 or 3% higher than average mortgage rate, but they're relatively very competitive. A lot of lenders have come out the last several years with DSCR loans, debt service coverage ratio loans. Like you said, it depends if your debt service coverage ratio is below 1.0 or above 1.0. 1.0 means you're getting $2,500, your payment's $2,500, and you're getting $2,500. So,
well, and rental prices are coming down, especially in apartment complexes.
Yeah, I gotta believe it's gonna be harder to cash flow. That's for sure.
Yeah, I think so too. Well, because you got to find that deal, and it's
yeah.
Here's where we're at, and this is on the MLS, so it doesn't reflect everything, but you can see that rental prices per square foot have come down. Pretty decent clip, down to $1.32, up from a peak here of $1.40. But a lot of rentals just don't hit the multiple listing service. But my middle son is looking for a place. He's going to move, I think, the end of January. So he's been pricing. He goes, every time I look, they're lower.
Yeah. Yeah.
He's looking all over, the Tempe area, Phoenix, and he said, I'm running in lower prices every time I log on, which is good news.
Yeah, and I think that's going to help, obviously, from an inflationary standpoint, but obviously from a rental standpoint, rentals, it's certainly going to be bucking against people can rent cheaper than they can buy right now if rates don't come down. That's the problem, affordability issue. But once again, how long are people going to rent? If you can only live in an apartment if you got 2 or 3 kids so long. That's what's going to push those people out of the from renting to getting eventually a house. But I think I'm somewhat optimistic. Last year was just a ho-hum year for a lot of people, it seemed like. But I'm optimistic if Trump can actually not be political, but just saying, looking at what he's saying he can do, if he can knock out some of these regulations, tap down at this inflationary bottleneck in some of these regulations, I think that'll help. But it's not. If anybody's looking for a Band-Aid, quick Band-Aid to help them buy a house affordability wise. I think it's going to be a slow grind.
I'm optimistic for the end of 2025, simply because I think we'll be seeing. Here's where I see the first quarter going, and I've said this before: that January is going to be really slow, but we're going to have a lot of optimistic listings. It's a new year. Here we go. I mean, it happens every year. You don't have to be a genius to know that that's coming. So it's like, okay, it's January. Let's get this house on the market now. Now, if I was going to list, I would list now. I would list now. I wouldn't wait till March, because if you list now and you list with an appropriate price, you don't have to deep discount it, but let the eyeballs catch it and go, that looks pretty good.
Mm-hmm.
You're going to get some action. But because in February, you're going to be up against so much more competition. So if you list smartly in January, you'll do okay. Because there are some buyers who are sitting back waiting, but I don't think we're going to go much above 2,400 contracts every 7 days for the entire 2 months. But if you keep adding to these listings in January and the first 2 weeks of February, we're going to start seeing a lot of price reductions in asking price at the end of February into our spring market. And so I think that's going to be an opportunity.
Let me ask you something. Do you feel like this? Do you feel like this real estate market is? Hey, Jackie, hope you're doing well. Happy New Year. Do you feel like this? I'm just going to throw that out there for just fodder and talk. Do you feel like this market's just kind of tired?
Let me get back to you just a second. I'm choking on something.
Okay, poor guy. I didn't know. So you want me to run the show for the next 15 seconds? I just thought it was kind of an interesting market topic to bring up. I hope I'm not just talking to myself, Rick. Help me out.
No,
here.
You're not. I'm still here. I'm battling a cold.
I know. Poor guy.
I hate it.
I talk to myself enough as it is. I don't want to be on a Zoom call talking to myself.
I don't think the market's tired, Pat. I think buyers are worn out. They're not seeing their affordability improve.
Yeah.
Jackie says, yes, she agrees. But I think they've just said, I'm just going to renew my lease.
Yeah. Yeah.
I don't know where this is headed. That's why I stick to my guns and say, yes, everybody was waiting in November, going to wait till after the election. And now they're going to get into January and go, I don't know where we're going.
Yeah.
I'm not doing anything.
Well, I think
the January spike in sales that some people are out there cheering, here it comes. It's not going to happen.
No, I don't see it. I don't see it either. I think when I say tired, I think the buyers have been, they're waiting for rates to come down. They're not coming down. The prices aren't coming down. Sellers, they maybe want to sell, but they're listed 20 or 30, 40,000 above. Eventually I think they will break and say, okay, we need to sell this. We want to sell it. And you're going to see a roll off on prices here a little bit, but
we'll see some relief. But it's not going to be major because that takes 3 to 6 months to shake out. So, Jimmy here's saying, is Chandler an up and coming area? Any new developments? As far as new developments, no. New building, they're pretty much out of land.
Yeah. I mean, Chandler is an up and coming. I mean, it's a coming area. I mean, it's been up and coming for several years, Gilbert and Chandler, but in terms of it's pretty much landlocked in terms of new developments. I mean, you're looking new developments. You got to go to 303 by TSMC, the Taiwan Semiconductor Market. I heard correct me if I'm wrong. I just read the other day that there's some big private investor that bought several thousands of acres up there too. That's going to be a big booming area. But then once again, you're talking, you're about 45, 50 minutes away from downtown Phoenix.
Yeah.
I mean, you're
Jackie here saying wait till after the 20th, then wait till mid-spring to see. Wait is the theme. I think so. There's more reasons to sit back and go, well, let's see how this shakes out than I think there ever was before. And so I think to your point, is the market tired? I just think we're squeezing out the excesses. We could see a pretty moderate downturn in prices if our inventory continues to go above 27,000 and we stay at 2,400 to 2,800 new contracts. That'll put downward pricing pressure on. But you know how that works, that the first 30 days, you haven't sold your house, you're waiting, and then you start offering concessions like, more contributions, doing this, doing that. And then on the third month, you consider a price decrease.
Mm-hmm.
So you're not going to see any of that in January and February, and you'll start
No.
seeing it trickle in March. And if the party doesn't start in March, they're either going to pull them off.
Yep.
We tried. We don't honestly have to sell. We just thought we'd try it. Maybe end of summer will be better. But for whatever reason, our canceled listings, we're going to pull them off. And or we're going to have to reduce the price. And it'll be a soft combination of the two of them, barring any economic shocks. And that's what people are also going to be waiting for. Is there going to be anything wild going on? Yes, been waiting for years, but if no improvement, we'll sell and leave the Phoenix area. Improvement in PR, improvement in sales, or improvement in affordability. I'm assuming you're waiting for improvement in sales. And I think if you've got some decent equity now, I think January is probably your best opportunity. I don't see spring being better for you as a seller. Affordability. Okay. Yeah. So I think affordability is going to take another couple of years.
Yeah. Yeah. I don't see anything dramatically improving either way. I think everybody is waiting for some golden spoon to like, okay, now's the time to buy. It's going to be just one of these, like, hey, if you're in a position where you need to buy or want to buy, certainly it's not, you're going to be able to get some selling concessions, maybe loosen up on the price, but I just don't see anything going, where houses are going to drop from $500,000 house is going to drop to $400,000 and rates are going to go from 7% down to 5%. Like, wow, we can buy now. That's just not going to happen. So unfortunately, I mean,
no, it's going to be slow. It's going to be slow. It's like the chart that we just looked at that showed that the number of loans under 4% has dropped by 10%, right?
Yeah. That's why I wanted to show that chart, because I thought it was kind of interesting how they're just kind of falling off.
Yeah, that took its time.
Yeah.
It's 10% better now, right?
Yeah. It's better than it was 2 years ago.
Had that low rate. You're saying they're 10% worse, but you have to look at, when you look at things over long term, then the trend becomes blatantly obvious. When you're looking this month saying, well, I'm waiting for something to pop next month, it won't. And then if it ends up being a shock, now you're frozen in fear. So let's say in the next 3 months, our prices start falling like a rock for whatever reason. It's not going to spur an uptick in sales activity, in buying activity. People are going to be frozen in fear. Oh my God, how much worse can this get? Because we saw that in 2008. But in 2008, people couldn't buy because they were walking away from their homes and they couldn't get loans. You can get a loan now.
Yeah.
So what'll happen is if things fall off, the smart money, and then I don't mean that by saying that we're dumb, but when I mean smart money, I mean the hedge funds, the investors, the ones that have the cash are going to swoop in. So if an opportunity does show up quickly, it's not going to stay there very fast.
No, it's not. I mean, that's the thing, is just nothing is.
So seeing things going slowly now, Pat, and seeing the opportunity for prices to start slowly coming down is not a negative thing for buyers, sellers, or our industry. Yeah. It's a normalization. It's not, I see so many thumbnails like this: slow, bad, prices down. Okay. Well, look, we get paid to manage the transaction. Whether or not you get more equity or less equity is up to the market. Yeah. So we don't make more money if prices are going up. In fact, in 2021, I never worked so hard in my life. Yeah. I've never showed so many houses where contracts never got accepted.
Well, that's the thing. That's the thing. I mean, I was talking to a couple buddy of mine. Yeah, you were riding around. I mean, you were driving around showing 20, 30, 40, 50. People were looking at 20, 30, 40, 50 homes before they were able to even get a contract accepted. I mean, and prices were going up. You're seeing, your bidding wars of $20,000, $50,000 over the. Is that people want that market, or do they want this market? Is what you're
I'd
basically
rather
saying.
have this market. I'd rather
Yeah.
have this market.
Yeah. So I
Yeah.
mean, I'm not trying to
You
convince
couldn't
people
even
to buy.
schedule. You couldn't schedule a tour for out of town buyers for the weekend. You had to
No.
say, "Let me know when you get off the plane, and we'll look and see what's here."
Yeah.
You couldn't.
Yeah.
You couldn't do it.
So I mean, that's just that. I mean, I'm not trying to tell people to buy or something, but I just try to give you the lay of the land. And I just think looking back on it, yeah, I was getting frustrated because I was doing pre-quals and everybody was getting bid out. They're like, yeah, we got bid out by $50,000 on this house. So look at this as kind of at least if you're in the market the next couple of months, look at it as a positive versus a negative. Because I said that's why I kind of brought up is the market tired? Because people are just kind of like time to maybe wake up and shake off your boots.
Jackie's got a good point here, Pat. She goes, "I was looking at expireds today, and there were a ton of them, weren't there, Jackie? And surprised how many were bought in 20 and 22. So people bought them thinking that the appreciation was going to continue at a pretty good rate. So they priced them high and said, well, let's see what happens. So let's set this to expire at the end of the year. And if I can't sell it, oh, what the hell? I think that's what we saw.
What the bottom line is, I think you have, like you said, we've talked about this too, is people are not there. It's definitely a lot different than 08, 9, 10. Back then, people had to sell. People have got equity now. They don't they don't have a gun to their head saying we've got, yeah, there are probably some people are in a tough position. Maybe they have to sell, but they have equity probably for the most part. And so that's why you're seeing this totally different market than you saw 08, 09, 10. It's just people have got equity and they got choices now. Like, let's just take the house off the market now. Let's sit for a while.
Well, there's outside forces that show up too that you don't expect. In other words, like the Canadian dollar is not as strong as it was. So that affects the over 55 communities greatly because Canadians, buy a lot of homes in retirement communities and their dollar's worth 70 cents versus ours. And so there went that market, right?
Yeah.
So, and Jackie says, and they have adjustables resetting the expires. That could be it too. Somebody, oh, wait, you mean marry the house, date the rate? Which goes back to one of our earlier comments here, and I hope I didn't ignore him. But Derek here said people better get used to 6.5 to 7 rates for the foreseeable futures. People continue to get sold down the river with the whole you can just refinance later nonsense. I saw one just the other day in a newsletter that I got where they literally said, "Don't forget, marry the house, date the rate."
Yeah.
That's great if you can count on it, but nobody thought the rates were going to go high by the end of 2024.
Yeah.
Everybody and their brother said that they're going to be lower. The forecasts were still putting us at the most pessimistic at 6.1, and we ended at 7. So, when I look at some of these, and even Realtor.com last week came out and said our prices are going to be up 13.2% in 2025. And I'm thinking, where do they get the 0.2?
Yeah.
It's like, why don't you just say they're going to be up roughly between 12 and 14%? But no, 13.2.
Well,
So
I mean,
I love forecasting season.
If rates do, let's say rates, I mean, people got kind of smacked around too in the September. People that had it, there was an opportunity. Let me just see here. Back right here from about September of this last year, September 4th, 5th to about the 17th, 18th. There was about a 2.5 week period where people could get in the high fives for refinancing. And actually UWM had a special running where they were knocking the rate down. And I was looking at some, 5.5, 5 and 5 ace. I mean, but this little two week window shows if rates do come down, people have to be ready. If they do, let's just say in the foreseeable future, the next year they do come down, there's probably a lot of people that were still some people jumped on that bandwagon, but it goes to show you that rates are not going to be down there forever. So, I mean, if you do have an opportunity to get into the fives, just take it and go.
Yeah. Yeah.
Because like I said, that chart right there I showed you was about a 2.5 week window where you could have locked your rate and closed in September. But that was, then you saw this it went from the 10-year treasury went from 3.60 to where we're at 4.56, almost 100 basis points higher. And that just goes to show you the treasury, the Fed's cut the rates by 100 basis points, but the bond market went up 100 basis points. So basically the market's telling, to the Fed, you're not getting this right.
Well, I was talking to somebody last week at a holiday dinner or something, and he says, well,
rates are
rates
down.
have gone down, right? And I go, no, they've gone up. He goes, but the Fed cut rates 3 times. I go, so?
Yeah.
The bond market's not following it. It's all based on 10-year treasuries. I said, it's very complicated, but when you just concentrate on the headlines instead of actually looking at rates and I've even had some family members tell me that their kids are, well, I think we can refinance soon because we saw that the Fed was lowering rates. I said, tell them to be careful. So I sent them a link and said, have them follow this. But Andrea's got a good point here. Richmond American in surprise, Desert Oasis 2 raised their prices by 50,000. Sales guy said they had to raise the price to cover the additional cost of the interest rate buy down.
Huh.
So here's the danger.
So that basically should. I mean, they're just that's that obviously they use their margins to get the rate buy down, but they're going to get squeezed.
Well, now if you bought that, you're actually paying 50,000 more for the house than what the true value really is because they're buying down the rate.
Yeah, yeah.
I mean, it ends up making the house like a new car. As soon as you drive that new car off the lot, it immediately depreciates.
Yeah, good point.
So, how are they going to appraise? Yeah, I don't know how those guys are appraising at some of those things, but I've also seen Jackie some homes like out in Eastmark where people are. I saw one that was like they started out at $599 and it was just a 2003 bedroom, 2-bath home, nothing fancy. And I thought, what made them think they could get that? And so you see some real surprises when you're going around looking at the listings that are out there now. And then yet you still see some that are priced right and they're gone in a couple of days.
Yeah. Yep.
You scroll through and go, wow, look at that. Here's the percentage of seller cost contributions, over 53%. With an average of 10 grand.
Yeah.
Which is where most of it's capped, right?
Yeah. I mean, if you're putting 5% down on a 5%, it's basically capped at 3% concession. You put 10% down, you get up to 6% concessions. But let's say somebody puts 5% down on a 400,000, let's see, 3%, 400,000 is $12,000. So that's basically $10,000 to $11,000, $12,000. You're kind of capped at that. Yeah. But that can get you a 1-1 buy down, 2-1 buy down. Once again, people have to be aware, on the 2-1 buy downs, as much I was definitely not pushing it, but just I think it's a good way for somebody to get in their foot in the door, no promises, but I tell people, hey, listen, just remember your rate was qualified. You're qualified at 6 3/4. Your rate's 4 3/4 right now. It allows people to pay off maybe a debt, a car payment. That's what I was using it for. Is like, hey, they had a car payment. Use that $400 to get rid of that car payment for the next year. That way you've got that loosened up for the next year. Use that $400 or $500 per month that you're saving as a way of, maybe tightening up your finances while you're in the house. And not just assume, oh yeah, now we got this lower payment. Then all of a sudden it moves from 4 3/4 to 5 3/4 to 6 3/4. You have to be, and you have to be smart about that 2-1 buy down.
Yeah. Yeah.
And I did that with one person not too long ago. Is basically said, hey, take this 300. It was like a $450, $500 a month. He said, yeah, we're going to use that difference to pay the car off, and that way, a year from now, we're going to be in good shape. We don't have the car payment. We got, we're helping ourselves financially. So
Ernesto here says, optimistically, 7-day of Q1 and inventory is rushing to the market. Can't wait. We're not seeing the rushing yet.
No,
we're seeing, And I don't think we're going to see a rush of new listings. I just think we're going to get back to the normal amount of new listings that we were seeing. You can see here, that's the green line here, 95,000. So this is a year-to-date number, so it continues to climb. But our new listings actually came in lower than 2022 and 2021, and slightly higher in 2023. So nothing rushing out. So I just got a notice here on Skype. Translated conversation requested. What? What a I'm being spammed by somebody. I hate this. Jackie said, I like the McMortgage. Rick, you should meet McHone.
Good one, Jackie.
The person that said that.
That's pretty damn good. Well, my buddy, I worked at Intel years ago when I got more. He called me up. He's like, McMortgage, what's going on? I'm like, I got to run with that a little bit more.
I picked up my son last week.
I love that. I never thought about that, Jackie. That's a good one.
We sat down in a restaurant in Ahwatukee, and a guy comes up and taps me on the shoulder and goes, are you Rick? And I go, yeah. And he goes, I knew it. He says, I'm one of your subscribers. He says, I saw you walk in the restaurant, and I thought, that looks like Rick from Rick Helps. So he says, I pulled up my phone, and I pulled up your channel. And he goes, that is Rick. And my son was sitting there going,
well, I had a different guy come up to me last week and say, are you Pat? I go, yep. He goes, put your hands behind your back. You're under arrest. I'm just kidding.
Yeah, that's right. You've been served.
You've been served.
I hate it when that happens.
That's why I never. No, my name is not Pat. No, I'm not Pat.
Yeah. You've been served. So, well, cool. Well, look, we're off to the races. I'm going to be really upping the exposure here. I want to interview a lot more people in the industry and outside of the industry. I want to really stay on top of this for Q1 and see what's going on. And so I'm going to be pulling up a lot of numbers we're going to watch. So like Ernesto's waiting for the surge in Q1 inventory. Ernesto, you'll see it. You'll see it on my 7-day moving average. It'll show up rather quickly. But it's going to take 2 weeks for that to show up because we got to erase New Year's Day. Yep. And so right now, this numbers that you see in the ticker below include Christmas week and New Year's Day. And so it's fun to look at, but it means nothing. And, but once that shakes out, then we're going to start watching it and see what happens and see where the trend is. And what I'm really going to zero in is, am I seeing new contracts going up further than where they were in the average? Because you remember when we looked at that 7-day moving average on my chart, Pat, it stayed right here all year. I mean, for at least 6 months, 2,400. So that has to change. And so we'll watch it here and share it with everybody as soon as it comes in.
Yeah. One side note that I saw just from my mortgage standpoint, which is really ticking me off, is credit reports are going up. Don't be surprised if you call a lender now that they're going to ask for maybe a credit card to pay for credit reports, because a couple of years back, credit reports were like $35, $40 a report for like a joint report. You know what they are now? $115.
You're kidding me.
Yeah. So for somebody just to call, be aware just for people out there that, they might be, getting hit with, say, hey, we need your credit card to pull credit. Because, now back in the day, somebody could call and, hey, I'll pull your credit and see what you look like. I mean, if I did that 20 times, that's, $2,000 a month. I mean, plus you add in maybe 70 to 80 different loan officers. So beware that people are probably going to be asked for that, because like I said, they've gone from $25, $30, $35 a couple of years ago to about $115 for the hard pull. The soft pulls aren't much cheaper. I can't remember. I'll get the price to you, but it's like, if I'm not mistaken, it was like $70 or $80 for a soft pull. I have to look at the Jackie. They've gone up ridiculous. So to get your credit pulled, it might, certainly it's not going to be as easy, or the cost might be swayed to the buyer initially. Because if you're serious, you're going to want your credit pulled eventually. But, once again, that's, for people shopping, who knows, that might, I don't know if every company is going to start doing that, but that's in effect there's one vendor that we said it was going to go to 115. So it's gotten out of control. I mean, it's asinine.
Yeah, they're just nickel and diming everybody to death. I pulled up this chart before I go here too, getting back to that delinquency rate. See where we're at? That slight uptick.
Yeah. Wow. That's huge.
So it's not alarming, right? So
yeah, it's alarming.
I mean, we're still way down here. So, so when you see these headlines, you always got to start looking at the details. But looking at that, the increase on that credit report that goes to the buyer. Well, the buyers need to stay on top of what their credit is and check it with the 3 agencies, the 3 bureaus, and have a pretty good idea where they're at before they pay you to pull a credit report. So they need to.
I'm not saying every lender is going to do that, but I think you're going to see that more and more because the days of just pulling your credit and seeing what it's like, I think are kind of gone too. Because like I said, if we're in that boat, I know other lenders are going to be in that boat too, and they're going to start passing that. I've been seeing that on Facebook posts and mortgage-related Facebook posts saying, "Oh, what are you going to do? I'm going to start charging a client," And like I said, the great thing about me being a broker, I pull one credit report, I can go to any different lender. I mean, it's good for lender A, B, C, or D, or E. So you go to a bank, they pull a credit report. You go to another bank, they pull a credit report. You don't like that, you pull, if you have 3 credit reports, pull at 3 different banks. Whereas I can use the same credit report amongst on the one deal, which is it's very advantageous.
That's a good point.
So,
well, Pat, will you have a good rest of the week and a good weekend? And we will see you probably not next week, but the week after. So,
okay. Yeah, let's do that weekend. What day is today? Monday, Tuesday, Thursday, Friday?
I'm going to have to check.
I have no idea.
Yeah.
All right, buddy.
All right. See you. Okay.